best way to think about this, I think, is that if I look at the best companies in my portfolio ever, across my 15 years of investing, they shared one trait, which was that they were able to grow in a cash flow accretive way. And it's absolute magic if you can do that, and it's a function of sales. So thank you, and thanks to the family. This is my second time in the family, and I have really been impressed by the spirit that the family has about welcoming people and creating a sense of hospitality. So I think there's definitely something to learn here. I'm going to do my best to just share a few lessons on enterprise sales. This is, as Vlad said, this is the first time I'm giving this talk, so it's probably terrible. I'm testing it on you, and I'm going to learn probably more about whether or not this is a good presentation than you will learn about sales. So I'll do my best. Just a quick intro to the fund. I've been doing venture for about 15 years across Europe and Israel. So these are some of the companies that I've backed. There's a few French companies in here. JFrog, which is one of the best performing companies I've backed, is a French founder, so it's a semi-French company. Now they've opened an office in Paris. But all of them are enterprise tech, all of them are deep tech. They sell into the US market. And this is just a quick view of sort of who we are and how we invest. I don't want to turn this into a sales pitch for Angular. We're obviously the best fund ever, so I'll spare you. But we have a lot of experience in working with early stage founders, writing very early stage checks into companies that end up doing relatively well and raising money from some of the better names in venture in the US, and this is some of the lessons from that. But more importantly, I just raised this fund fairly recently. And so I consider that my sales journey. So some of this is informed, or the majority of what I'm about to say is informed by the companies that I worked with and what I learned from accompanying them on their journey. Some of it's from my own personal journey. And what did that journey look like? About 4 years it took me to raise the fund, flew 1.2 million miles, met nearly 1,400, had 1,400 potential investors in my CRM system, spoke with about 600 of them, met about 300 of them, and ended up closing just over $40 million. And this I think is an interesting slide because I think this reflects the journey of a lot of enterprise sales founders as well, which is this represents all the LPs in our fund, and the size of the pie slice is the size of their check. And so we have about 60 LPs. Only about 28 of them are, I would say, significant size. And the largest one is 40 times the smallest one. And so massive difference in sales process and massive difference in value, right? And I love all the LPs obviously, but in terms of if you just look in sheer dollar amount, I had conversations that went on forever and resulted in a 100K check, and I had conversations that were really fast and resulted in multi-million-dollar checks. And as I write here, one LP was just a 20-minute meeting, and he signed a check. The other one was a 3-year process. And I had 3-year processes that converted and 3-year processes that didn't convert, and so I feel like I've earned a little bit of stripes as an enterprise sales guy in my own right. It's also interesting to just reflect a little bit on what the word enterprise means and sort of deep tech versus enterprise, because these terms get thrown around quite a bit. I've actually written a blog post about this, and this is the graphic from that blog post, but we at Angular think about the world as dividing into 2 categories, at least the world that we invest in. We invest in companies that I would describe as deep tech, and that means they have some significant technology that is some kind of a barrier to entry. It's hard to emulate. There's some innovation there, technically speaking. We also invest in enterprise tech, or enterprise companies, right? So what enterprise to me means is that you're selling to someone who's a sophisticated buyer. For me, that's the delineation, right? Some people use that word differently. They use that word to mean it's a traditional enterprise software sales to an enterprise in the sense of it's a Fortune 500 or a CAC 40 company, right? That's the kind of company. I think about it a little differently. It's non-consumer and non-medical and non-government. It's a company buyer where the person you're selling to is an expert, and buying your product is part of their job description. And they probably know more about your market than you do, in the sense that they've met all your competitors if they're good and are going to select your solution among the other options that they have. Obviously, there's that intersection of you have deep tech and you have enterprise, but you can just be one or the other. So I'm going to share with you just a handful of lessons that come from this. And again, the first time I'm giving this talk, so I apologize if I'm all over the place. But one thing I think is important to recognize is that product market fit is like this magical moment in the life of a startup. And there's a lot of times that founders will come to us and say, well, I've achieved product market fit. And sometimes I even believe them and I agree, yes, you've achieved product market fit. And then 2 years later, we realize, oh wait, now we have product market fit. We didn't have it before, right? And that's a magical moment, because what product market fit means from a sales perspective is that when you actually have product market fit, your sales motion, your sales process becomes natural, right? You have something that the market wants to buy. They want to buy it to the extent that it's repeatable. You can have conversations with them. You're starting to get the materials together where you can make that happen. Before that, it's unnatural. There isn't a product market fit. It means you have something that they don't exactly want, or don't exactly know that they want, or you don't know exactly how to talk about it. You have something, but you're selling a different aspect of it than the one that is actually going to make them buy it. So a lot of times when I'm talking to an early stage founder, I'll ask that founder, what is it in your product that your customers, like don't pitch me as the VC. When your customer sees this screenshot that you're showing me, what on this screen is the thing that makes them the most excited, right? To try to understand where are they in that product market fit journey. And the reason I want to start with this is because until you're in product market fit, you have to sort of accept that a lot of the stuff you're doing is unnatural and isn't going to scale and isn't going to work and may not be repeatable, but it's part of the learning process of getting to that point. And I think it's much better to be honest with yourself and with your investors about the fact that you're not there yet. It also is important to be honest with your employees and your team about, look, we haven't figured out what we're selling. We haven't figured out what features we need to emphasize. And just understanding where you are in this journey really matters. Over time, market resistance tends to decrease. Your ability to sell increases, and eventually it flips over and it gets a lot easier. But before that, it's really hard. The other thing is you should embrace the chaos of what enterprise sales look like. On the left is in theory what enterprise sales look like. So I'm going to come back to this chart in a second. Yeah, you have all these things, leads and lead generation and sales qualified leads and marketing qualified leads and all those things. In reality, enterprise sales in the early days can look more like the picture on the right, where you're sort of clinging for dear life to a handful of accounts just because you know that if you can close that big account, you're going to bring in $1 million deal, and your VCs will love you, and your employees will believe in you, and you'll have cash, and right. So usually an early stage startup is living on the right. You may have some graphs to impress people or to convince yourselves you know what you're doing, but in reality, you're just clinging to some hope of a process, and that's totally natural and it's totally okay. So here I've put that sort of standard slide back, right? And I'm not going to go through that. You can find a lot of blog posts about it. What I do want to say is that there's this concept of a sales funnel, right? Which is you do a bunch of things to generate leads and you try to push things through the funnel. And as you scale, you try to scale that funnel and tune that funnel and optimize that funnel. And people use all these phrases to talk about how we're going to optimize the funnel and understand our funnel. The earlier stage you are, I think the more important is to realize you actually want to approach this, I think, backwards, right? We see a lot of early stage companies, even in our own portfolio, that say, oh, now that I have like 300K ARR, I'm going to start investing in marketing. And I'm like, why? What are your sales guys going to do with 2,000 leads? If I could give you 2,000 hot leads tomorrow, what the hell would you do with them? Right? You don't even know why your customers are buying from you yet. Right? You can't even retain the customers you have, let alone close a new one. So, right? Or you don't have the salespeople, you don't have the support engineers necessary to deploy these things, right? So I'm increasingly starting to think that the right way to approach this is actually backwards from the bottom of the funnel. So in other words, for example, customers are at the very bottom of the funnel. Let's just make sure that the existing 2 customers that we have are incredibly, incredibly happy, right? Because we need them to talk to VCs to encourage them to invest in our next round, because we need them to act as reference customers to our next customers, because if we lose one of them, we're really hosed, right? And then maybe you can say, okay, let's understand how we're going to convert an opportunity, right? At the very end, once you have the funnel built up, then you can think about, okay, if I drop marketing budget and I get leads, can I maybe process those leads and bring them in, right? So I would think about it backwards as opposed to forwards. Lesson 4, and this I can say I learned absolutely on my own skin, is process is really, really important. My fundraising completely sucked until I used a CRM. This is Pipedrive. This is what I used. These are not my LPs. This is a screenshot from the internet. But the point is, once I had a process, even as a one-man show at that point, I was able to understand where I was. I was able to track myself. I suddenly had metrics. And a lot of times, as the VC, I find myself asking companies, whether it's deal flow or even in the portfolio, how many leads do you have? And you get these fuzzy answers because they don't have the actual numbers, right? And then other companies will say, oh, let me just give you a screenshot of my pipe driver, a screenshot of my Salesforce. And those tend to be the ones that are doing really well. They also are the ones that are extracting data for themselves so they can track their own progress, and that's really, really important. So the more you can invest early on in tools and build a culture of metrics is really, really important. Lesson 5, the cavalry will not save you. I think this is something that companies all over Europe and Israel struggle with. There's a very, very seductive idea that you're going to hire some big expensive sales guy and he or she is going to somehow save you because they show up with a Rolodex and they know how to sell and they can talk about their quota attainment and all this other stuff. I have found that this absolutely never, ever, ever works. There's a real magic to founder-led sales. There's a real magic to learning how to sell yourself, how to manage a sales process yourself. That's the reason why you should do it. The reason why you should not hire any of these senior guys. They lack startup DNA. They're extremely expensive. They are accustomed to a level of support and resources that as an early stage startup you typically can't provide, and so they get frustrated really, really easily because they think that they're moving from being a junior salesperson at a huge company to being the VP sales for you. It's going to be great. But they don't realize that they don't have an assistant anymore, they don't have a marketing team, they don't have a graphic design department, they don't have a budget for business class travel, all the stuff that they used to have, they don't have anymore, right? They also don't necessarily realize that you haven't figured out the sales funnel yet, right? So they're not typically entrepreneurial. The other point here is that salespeople are typically, they're motivated by money. They're wonderful people, they do amazing work, they're the most important people in the organization, but the majority of the very successful salespeople out there are motivated by quota. That's what motivates them. And they're not typically geared to think in terms of equity. They don't normally think about, oh, you've given me 1% of your company, that's amazing, I'm gonna make $1 million. They think, oh, if I hit my quota, I'm gonna make $1 million this year, right? Because that's their alternative. They can go to SAP and do that tomorrow. So it's a different mindset, and they're usually not willing to be patient with that learning process. They want to hit that quota today, right? And they're usually not able to, they themselves don't realize how difficult the startup journey is. And the final point here is, why are they talking to you? In other words, one thing they're really, really good at doing is selling themselves. So I found that it's extremely difficult for a first-time early stage CEO/founder to correctly assess a experienced salesperson who's probably had many, many sales jobs, which means they've convinced many, many people to hire them, right? They're really good at selling themselves. You're not really good at buying that product, and so you're at a huge disadvantage in that kind of negotiation. Lesson 6, your pricing is almost certainly wrong. I was just talking with Gaetan about this. It's almost always the case. Pricing is incredibly complicated, and rather than going into all the details here, I think we'll talk about in the panel, but accept the fact that your pricing is usually wrong. Understand the many, many different ways you can price. You can feature-based, per seat, per volume, volume-based, value-based, freemium features, open source models, discounting, multi-year. There's just a ton of different ways you can think about pricing, and you have to get it right, and it's super complicated. It's probably more complicated and more subtle than getting the product right. It's getting the pricing right. And you should think of pricing as a critical feature of the product itself. It really defines what the product is right? If you think about a flight, right? There's a first class product and a business class product and an economy product. The price makes all the difference there, right? Like it's a key part of the product. And so don't be afraid to experiment, and think about this in terms of total cost of ownership for your customers, not just the price they're paying you, but the total investment that they have to make to use your product, right? So one of the things that I look for as an early stage investor, and I think early stage founders should pay attention to, is how much are they investing in using your product? Even if they're not paying you yet, if they're putting 6 people to use your product full time, right? That's $600,000 of investment they're making in getting your product to work. It means your product is adding value to them, right? So those things can be very, very important. And the final point is raise your prices. Like almost always. I don't think I've ever, in 15 years of investing, advised a company to lower prices. I think I've always found myself advising people to raise prices. And we'll probably come back to that point later. sometimes $1 million is just as easy or just as hard as a 50K check. I hinted at this before when I talked about my own fundraising journey, but founders should, and early stage founders should not be afraid to go after big deals, as long as they're not too big or too slow or too complex or too unique. I remember once talking to the founders of Sisense that ended up, now they're doing over $100 million a year in sales. But this is when they had no sales at all. And I asked them, what's the risk that you are facing? And so one of the risks we're facing is that Walmart comes to us and says we want to be a customer. And I was like, why? And they said, because if Walmart says we're going to be a customer, we're not going to be able to say no, and they're going to kill us. So there is a real danger to dealing with some of these massive accounts because they can take over your life and they're not repeatable. But generally speaking, you should not be afraid of asking people to pay a full price, if for no other reason than just to hear the response, just see what they say. So many times when I'm doing diligence calls on companies, I will ask a customer, obviously with the permission of the founders, but I'll ask the customer, say, look, you're going to get special pricing because you're an early customer, but what's the real price for this? And they'll say, it's way higher than what they're charging me, right? So you need to run those experiments yourself, and don't be afraid to ask the customers. The other thing I'll say is, you don't get points for penetration pricing. You get points for winning customers, but you don't get points for winning customers by undercutting your competition and selling something for cheap. I'd almost rather see you give it away for free as a trial process, but communicate the right price. Say, look, this is $100,000 software. I'm giving it to you for nothing, but it's $100,000 software, right? If you want to renew in a year, here's the price, right? But the conversation you should be having with your customers should reflect the real price. This is probably way too much for one slide, but these are two graphs. The slide on the right is the famous slide from Christoph Jans, who's the founder of Point9 Ventures in Berlin, probably the leading SaaS VC in Europe, maybe the world. And the slide on the right is from a guy named Nathan Latka, who's amazing and just gathers a ton of data on SaaS models. They're really, in many ways, they're the same exact graph. They just flip the axes a little bit. So if you look at, this is basically what it's easier to look at the one on the right. So basically what Christoph is saying is there's 5 ways to get to $100 million in revenue, right? You can either have, whatever, $100 million accounts or whatever. Most large SaaS companies end up being what he calls deer or elephants, right? They have ARPAs of between 10K and 100,000, right? That's how you can, and the 100,000, you can think of that as sort of extending up to like 300K. It's really, really hard to scale a business if you're selling less than 10K a year, if that's your pricing point. It's also really, really hard to scale a business if you're selling a price point of over $1 million a year. Doable, but extremely hard. There just aren't that many customers that can pay that much money, and usually when a customer is paying that much money, there's too much customization and bespoke work, and it takes too long, or the deal sizes are too long, it's too hard to hire salespeople, just really hard. If you're charging way less than 10K, you can't even hire salespeople to run that sales process for you because they're not making enough money to work for you, right? So the sweet spot for software businesses, at least, is usually somewhere between 10K at the bare minimum to probably more like 300, 500K at the high end. Those are the businesses that tend to scale, and that's exactly what Nathan is showing on the left. What he's showing you is a sampling of companies, and the companies above the second line are companies that have the metrics to be a $100 million sales company, and they're all kind of in that range of 10,000 to over 100K, right? The title of the slide is really the point that when you set your price point, when you decide to go into business where you can charge $10,000 a year for your thing, or you're charging $300,000 a year for your thing, that determines almost everything. It determines who your customers are, it determines what kind of salespeople you can hire, it determines how you're going to compensate them, it determines how many deals a year they can do, it determines how much support, customer success, sales engineering you have to do to support that sales. The entire DNA of your organization is going to be shaped by that decision. And so getting that right and having everything work in balance really, really matters. A salesperson who knows how to sell $10,000 of software over the phone is going to have a very hard time getting on a plane and closing a $300,000 deal, and vice versa. So all of that has to be in balance. I'm not going to read all this slide, but in the PowerPoint version of this slide, it animates. It's a little easier to understand. But basically, unit economics are everything. The reason that ARPA shapes your destiny as a company is because unit economics drive this whole thing over the long run. And what I'm trying to illustrate in this slide is that you need to think about unit economics in a multidimensional way. and I probably got this slide wrong. I need to tune this slide a little bit, but the point I'm trying to make here is that there's the unit economics for you, right? And then there's the unit economics for your customer. They have to be experiencing the ROI, and you have to be experiencing the fact that you're profitable on a per customer basis, right? There's two sides of that equation, right? The ideal company is making money and selling profitably, but if you ask their customers, the customer's like, oh, this is amazing. I'm 10xing my investment. My ROI is 10 times, right? I'm getting my investment back in a few months of time, right? At the same time, it's based on customer and based on salesperson. In other words, there's unit economics on a per customer basis, right? What does it really cost you to sell to that customer? All in. What does the support cost you? How many hours are engineers spending customizing stuff and integrating things? But also for your sales organization, for a salesperson, if he or she hits their quota, can they hit their quota? Are they going to make money? Are they going to have a really nice bonus that year or not? Right? So all of these things have to work in balance, and getting that right is essential. If you don't get that right, it isn't going to work. As a founder or CEO, accept your role as salesperson-in-chief. Right? This is your job now. Right? Pretty quickly, you're going to figure out if there's a market or not a market, and if there's a market, you're going to be selling. And you're selling everything, by the way. It's not just selling the software or selling the product to customers. You're selling your company to employees. You're selling your equity to investors. You're selling your vision to partners. You're doing all of that stuff. So learning how to sell and embracing that vision and looking at sales as a good thing to learn how to do is a thing that's highly correlated with successful founders. And ability to sell, I think, is ability to survive in many ways. And you know, there's sort of two paths to survival. You can convince a VC to give you money, or you can convince a customer to give you money. I'd much rather learn how to convince customers to give me money. It's a much better thing. Discover the buying process, right? Which is the same thing as discovering the selling process. And I've had many, many conversations around a board table with early stage founders where we're talking about customers, and they list, you know, I have this big customer and they're in this part of the process, and I thought they were going to go away, and they came back. And I mean, we just had, for example, one of our companies is selling very high priced, you know, 200, 300, 400K per unit optimization software for heavy industry. And the founder is a brilliant engineer, and she was saying, you know, she had these like 4 customers, and they're all going to be huge. And then the next week she emailed me, and they all had disappeared. And then 2 of them came back, and then the other 2 came back, and then another one disappeared. And I was like, Vicky, like, you know, what's going on here? And she was like, well, I thought they disappeared, but they came back. They just went quiet for a few weeks. And I was like, well, okay, so we need to like redefine our process, because you can't, your own forecast can't be that you had a forecast of X million revenue and then 2 weeks later it's gone to 0 because you haven't gotten an email from someone in 2 weeks. Like we don't understand the process. And every company has a different buying process, and who do you need to buy into the process? What are the stages that these customers go through as they make a decision? What are the blockers? Who are the people that, you know, maybe the engineers love what you're doing, but the CFO hates it, or vice versa? So understanding that process and discovering that journey is a critical part of getting this right. When I think about how sales drives the perception of value for a company, and when we think about, okay, raising the next round, and the idea is obviously to raise as much money as possible at as high a valuation as possible from as good an investor as possible, I think there's really 4 vectors of revenue quality, right? There's kind of 4 directions you can push things to make your company better, right? The obvious one is volume, just the sheer number of revenue that you have, right? Doesn't matter if it's good revenue or bad revenue, just show me a revenue chart that's going up and to the right, and a lot of VCs will be happy with that, and you should be as well, right? A lot of times as a VC, I'm like, I don't understand what they're doing, I don't understand why it's a market, but it's growing really fast, and they must be doing something right, so I'm the one, if I don't get it, I'm wrong, right? That's sheer revenue volume. Revenue value is also really important, I think. It's how much could they pay, right? In other words, if you can get your highest paying customer from paying you 50K in Q1, and then you say in Q1 of the following year we had a customer paying us 300K, you've proven something. You've proven that I could take some percentage of my pipeline and I could multiply that by 300K instead of by 50K. You're moving the goalpost further down the field in value per customer. That's a really important driver as well. And sometimes for a Series A investor, just show them one customer. Just show them one customer that's paying you a ton of money and convince them that's repeatable, and they will give you the benefit of the doubt that you can convince many more customers to pay you that as well. Velocity is also really important, the speed of revenue growth, for obvious reasons, and the validation. Who is it, right? So if you have Goldman Sachs paying you, or even Goldman Sachs not paying you, that's pretty good, because they don't buy software from a lot of people, right? So that can be very, very impressive. One of the better companies in my portfolio had Goldman Sachs as a pilot customer, and that drove their A round and their B round. Goldman Sachs never paid them. I'm not even sure they're using it anymore. It didn't matter. They had validation from the best tech buyer in the world that this was really interesting software, right? Not all revenue is created equal. This is Indiana Jones holding the Holy Grail. So the Holy Grail is like recurring license revenue, right? That you're getting the cash up front. That is the absolute Holy Grail. The worst revenue, from a VC's point of view at least, is professional services revenue. It's not scalable, it's expensive, it's low margin, it's not repeatable, et cetera, right? You want to sell more of it, you need to hire more people, it's annoying, right? License revenue is a bit better, recurring license revenue is even better, 12-month commitments even better than that, and then cash up front is the ultimate thing. And the best way to think about this, I think, is that if I look at the best companies in my portfolio ever, across my 15 years of investing, they shared one trait, which was that they were able to grow in a cash flow accretive way. And it's absolute magic if you can do that, and it's a function of sales. In other words, if you can sell 100K of software, and you can charge 100K per year of software, but you can sell 3 years in advance, so someone's committing to give you 300K, and then you can say, you know what, give me 250 cash right now. You've basically paid for a new salesperson right then and there. Then you hire another salesperson, you get that guy to do that, right? And then you can actually grow in a way that doesn't consume cash. This is the holy grail of business. If you grow in a way that doesn't consume cash, people will literally throw money at you, because you built a magical cash machine, which is what we're all trying to do at the end, right? So how you structure your sales process and how you incentivize your salespeople to use your commission structure to motivate them to sign longer-term contracts, to use your commission structure to show that you understand that not all revenue is created equal, and to motivate people to bring cash forward. You can give a salesman as much, or a saleswoman, as much cash as you want in bonuses, provided they brought the cash in from customers, right? Repeatability is better than revenue. It's almost the same concept, right? You want to have repeatable sales. So being able to convince investors or other customers or new salespeople hires that you can sell repeatedly is much better than convincing them I sold $1 million to Walmart, but I'm not sure I can do it again, right? Sales-driven product is essential. Think about all the ways that you can take what you're learning in the field about your product and use that to improve your sales process itself. Put another way, if your VP sales was in charge of your product direction, what would she do? What would she ask you to change about your product to make it easier for her to do her job, which at the end of the day, she runs the company, not the product people, right? You want to have a sales-driven organization, a sales-led organization. And finally, don't worry, I'm not going to read this, but Sequoia on the internet has a 10-slide template for what a Series A pitch should look like. So Sequoia is a VC fund with authority. I'm willing to take their 10-page structure as a starting point. The point I'm trying to make here is that your Series A pitch, if you're doing your job really well as an early stage founder, your Series A pitch should really be mostly about sales, right? Because what you're doing at the seed stage or the pre-seed stage is you're trying to convince someone like me that, hey, I'm a capable founder, there's a market here that's interesting, I probably can sell a few of these things, and I can get to a Series A. At the Series A, the conversation changes. At the Series A, are you a good founder? Are you a capable team? Is there a market? Those questions are going to be answered in about 5 minutes. No Series A investor is going to spend more than 5 minutes struggling with those issues. They probably know the answer already. The question they're going to be asking themselves is, can you scale revenue repeatedly? You will not have been able to prove that yet, but you're going to come with some evidence that you might be able to do that. Right? That's the conversation they're having. Series B, you will have already proven that. Right? So Series B is easy. It's like, oh, you can prove repeatable sales. How much money do you want? Right? What are the physics of your business, and how much money do you need to scale? Right? Series A is that magical point where you can't prove it yet, but you can have the discussion. Right? So my view is all the stuff you're doing at the seed stage, all the stuff you're doing pre-A, all the stuff you're doing with the capital of funds like Angular is building evidence that you can have that conversation about how are we going to scale sales repeatedly. You're not going to be able to prove it, but you're going to be able to argue it. And that's what you should be focused on doing. So if you have a choice between, do I sell $1 million deal to Walmart, or do I hire a salesperson and then demonstrate that that salesperson can sell 200K of software on a 100K salary, I would do the second thing. Because if you can get one salesperson to do that, you can probably get 10 salespeople to do that, and then you have a business, right? Having the CEO walk into Walmart and charm them and walk out with $1 million, it happens, but it's not repeatable, right? So ultimately, the whole thing kind of converges around, can you convince a Series A investor that you can sell repeatedly, and all the things that you're doing, all the things you're talking about in that meeting are really about sales at the end of the day. That's my story. Thank you. Hopefully that was helpful. Good luck, family.